Maybe you just start, just to introduce yourself and your current experience.
Okay, I'm Neil Chisman. I used to be a finance director. Stackis PLC was the longest-serving company that I was with, and there I was also the, if you like, the chief pension fund trustee, so responsible for appointing the fund management of a sizable fund. We've talked a bit about the losing trust in 2008. I think I actually lost trust much earlier than that. Back in the 1980s, when I found that my investments weren't performing very well, and it turned out that the manager had been churning the portfolio to get a lot of fees out of it. But those were hard days. I developed, after that, quite a lot of cynicism, to the point where I took the view that if somebody really was very good at picking stocks and making money from them, they wouldn't be doing it with my money, they'd be doing it with their own money. So you've got to anybody that pitches to you on the basis that they can perform better than others, I'm cynical about. So my portfolio is largely in ETFs and iShares and stuff of that sort. Then we'll have to be getting on with.
Yes, lovely. Tom.
Tom Kidman. I worked in IT from the days when things were so large you couldn't imagine it for what they did. And we didn't have discs either in those days. So for about 40 years, but I first bought shares when I was 15. So I built up my portfolio since then as a do-it-yourself. And I would echo a lot of Neil's comments there that I was very concerned with financial advice that seemed to be extremely self-interested. It is all about commission, consequently churning, who's being looked after. And you can see it over and over again. You can see it very recently up to 2008. It happened to my father before he passed away 9 years ago, whatever. I've taken a different tack over my life. I've done all sorts of alternatives, wine, woodland. I've done the theatre, small-scale stuff, BES, EIS, VCTs, done it all. But for the last 30 years, where I've built my money has been in investment trusts. So I would say that in many ways, I've ended up being a fund of fund managers. And therefore, what interests me is who is running my money directly, whether it's Alistair Mundy, Nick Train, Neil Woodford, etc., who is running the particular investment trust I've invested in. And I've gone to that level, thus obviating any need to go to a financial advisor. If I could just turn it round, because I'm not sure where I am with the questions there, but if I was going for a financial advisor, and after all I do take some advice, such as in tax affairs, then this is where my biggest complaint is, that it is, and an example was my father. The company concerned sold all his AIM shares when he was in his 80s, when they took over the portfolio. It was obvious he wasn't going to live forever. Those AIM shares continued to do very well, and 5 years later when he died, of course, we instead had something to pay IHT on. So absolute thoughtlessness in a way. What we want is something to integrate everything and turn it into a holistic profession for it to be worth us being interested in going for. Stop there.
Thanks, Tom. So for you, it's the kind of holistic integration of
to make it worth me doing
tax.
more than a do-it-yourself in a way, because I feel that I'm part do-it-yourself, but I am also employing a fund manager to if I buy an investment trust, I'm employing that fund manager to invest the money that I have, that pool that I have put with them through that number of shares.
Yes.
So I'm sitting on both sides.
Lovely.
Possibly.
Thank you. Martin.
I suppose I'm a DIY investor, very much so, in a way, therefore why am I here? But when I was asked the various questions, I did have quite a lot of comments to make about how I saw the industry. And that's partly because I've been in it to a degree. I'm an actuary. I started off in life insurance in an outfit called Save and Prosper Group. And that was sort of unit trust and savings. And back then, we didn't actually rip off the client too much. The charges weren't that bad. When they made changes, we didn't rip them off. Then I became a pensions actuary, advising large companies and pension funds. And eventually, I became the first actuary working for Lloyd's of London, the insurance market, which was hugely interesting. With that experience of working at Lloyds, I became very much aware of the conflict between agent and principal. And back in about 1992, there was a letter to the Investors Chronicle, another one to the Financial Times. Individuals were thinking about what can we do to represent private investors. And I responded to that. And we set up an outfit called the UK Shareholders Association, which I was chairman of for a while. And I spend some of my spare time working on policy issues for them. So I'm an actuary, and in theory, actuaries should be relatively well armed to think about investment. But in practice, not that many do. It's quite uncanny. I have, for example, a big SIP. It costs me £200 a year flat. I never pay percentage of fee to anyone. That's number one point. And therefore, I'm interested that individuals should be appropriately advised about finance generally, and it would be wonderful if some of the thinking that's done with the interests of high net worth in mind were able to cascade down. And then we get issues of coaching, education, but some of the things that people really need to know about investment, the really fundamental factors, in my experience, the financial industry is not keen on pushing. One, of course, John Author's serious passion there, you can tell in his articles, but he proves it when he speaks, is the importance of expenses. But other things, such as how do you react to market falls? I mean, I happen to believe that what we had the last few years ago was tiny as opposed to what's come. I think the level of self-delusion and propping up of asset values and hoping it will go away is just amazing. And I can't see how we're not actually becoming poorer as a nation, but not seeing it. So I think that there's an amazing crash to come. But individuals need to have a way of thinking about what they own. If I own something, do I want to own it for decades? Okay, tick, I'm happy with that company. How am I going to react when the price falls by a factor of 4? Well, if I've prepared for that, and I haven't got all my money in something that's going to require it to keep at a market value to live, then I'm going to say, great, I'll buy some more. So when the market crashes, it's marvellous. So frankly, I'd personally be better off. Now, it's interesting, the point that John Author's made about people putting their money in cash. I think on a long-term basis, you've got to hold good quality companies with a lot of your assets and not worry about it. And you've got to think decades. But you still have to be prepared for market fluctuations. I think something huge is happening. In terms of if you like, putting it right and getting trust, there's the slide that talks about understanding the client mindset. I think it's the next one. Understand the client mindset, guide and coach. There's no number naught there. Number naught is care about the client. So imagine you were working not for just clients, but your children. How would you like them to be treated? How would you like them to be educated about how to think in the long term?